It's Julie from the Mortgage Center. Welcome to my first time home buyer webinar. This webinar will be recorded. I know there are some real estate agents on the line that may want to share this with their clients. So hopefully I give everyone the information that they've been dying to know about buying their first time home. So just a little bit about me. I specialize in home purchases, cashback mortgages, which used to be known as zero down. Now they're known as called flex down, refinances, equity takeouts, and also leasing options. So I do have some rent-to-own lenders. I don't do a huge amount of them, but if you don't qualify for a mortgage now, I can definitely give you some advice on how to get there. So try to make this as quick as possible because I know everybody probably wants to be out in the sunshine right now. So just some information about why you might want to use a mortgage broker over your local bank. So I have access to 40 plus lenders. I can use your bank that you use, or I could choose a different lender with a different product, depending on what your needs are. Normally my interest rates are lower than the banks. I do work flexible hours, constant communication, so a lot of my clients have me on text, and I do try to produce quick responses, usually a couple days maximum. And I also work with a team of experts, so I can recommend a real estate agent, home insurance, whatever you need in regards to your first time purchase. So I wanted to touch on some credit tips just to get you to where you need to be to purchase your first time house. Your mortgage acceptance will be largely based on your credit record, and the amount of mortgage that you qualify for will be influenced by your income, the amount available for your down payment, and the current mortgage rates. So typically lenders want to see 5%, but we can again look at the flex down products. If you don't have a savings, sometimes what we can do are RRSP loans, potentially borrow the down payment. Each product is going to be different for each person, and depending on what product you get, it's also going to depend on what rate that you qualify for as well. So the first step before you go see your real estate agent would be the pre-approval. So what usually happens is I have the clients come in and take an application in order to determine how much they can afford and how their credit is. So when they're in my office, I usually ask them to bring their social insurance number, some income information, and I do a credit check. Often when you go into your financial institution, they wait until you have the offer on the table to do a physical credit pull, and then you may have some surprises. So we need to make sure that there's nothing on your credit bureau that's going to affect your mortgage approval, just so that you avoid disappointment. So some ways to keep your credit score high would be to keep all your credit card balances below 75% of the limit. Do not miss any payments. Past mortgages as well as phone bills that do show on your credit bureau now, so definitely make sure that you make your payments on your phone bills because it will affect your credit now. Keep your credit inquiries to a minimum, so 2 to 3 months apart. After 6 months, the inquiries actually don't affect your credit, but try not to do a whole bunch of inquiries at once. A lot of times when you go to purchase a car, for example, you'll go to the dealership and they'll have their in-house financing. Well, what they'll do is they'll pull your credit and then they'll shoot it out to 5 or 6 different lenders, and they'll each take a credit hit off of you to pull that credit until somebody says yes. And then what will happen is your credit score could potentially go down. So you can request a free credit bureau once a year from Equifax. So it's www.equifax.ca to make sure your information is correct. So if there's something that needs to be fixed on the credit bureau, oftentimes I can help you with that, and we can get it done fairly quickly so that your mortgage approval can happen sooner than later. Okay. Okay, so other factors that may affect your approval by the lender is most lenders like to see 6 months plus on a job. If you aren't on your job for 6 months, we still may be able to get you a mortgage. That may not be an issue. If often what we'll do is we'll prove job history. So if you've been at a job for say 3 months and you've done your probation, but you've been in the industry for several years, then that's going to definitely help your case. If you're on contract, but again, you've been in the industry for a while, we may be able to look at certain lenders for that as well. Something I do tell people to remember is a lot of my clients are very focused on rate. And yes, it is my job to get you the best rate. But if you've got something that's not in your favor, at that time, it becomes more about getting the mortgage than it does about getting the absolute lowest floor rate. And usually we're talking about like 0.20 or something of a difference. But, you know, then you've got your house and you're not renting, right? So they also like to see a stable residence history. So it goes back 3 years on the application. So if they see that you've moved around a bunch of times, that's going to make them a little bit uneasy about lending you money. The more you move and switch jobs, the more unstable you look from a lender standpoint. So they want to see consistency. What I would recommend if you're in school or you're not really at a stable residence, you might want to look at using your parents' address or a family member's address, just so that you don't have 10 different addresses in 2 years on your credit bureau. Addresses do show up, so we want to make sure that you've got something stable on there. I think we already touched on the mortgages and the loans. Credit union loans, they're starting to be reporting on your credit bureau, but sometimes they only report if they're delinquent. Mortgages, some of them do, but not all lenders. So it's going to depend which lender you had a mortgage with if you're not a first-time home buyer. So for income verification, what we need are recent pay stubs, no older than 30 days. Usually one is fine. A letter of employment. Every employer usually has a standard template. I know some of the companies that I have in this area are smaller companies, and they don't necessarily have like logos and big HR departments. So sometimes we will have to get something to just show that they actually exist. A lot of my lenders are in like the GTA area, so they may not have heard of the company that you work for if it's a small family-owned business. So just keep in mind that there may be some additional documentation, and it always needs to be signed and printed on company letterhead. Normally what they're going to look for in that letter is that your salary on your pay stub matches what you've got on your letter of employment. So we can also count overtime when we're verifying incomes if you need it for your application. I don't like to give the lenders any more information than they absolutely have to have, or they start asking for more paperwork. So if you do need to count notice of assessment income, so if you're making bonuses of any sort or if you're on commission, just ensure that you are paid up on your Revenue Canada tax money. If you're not, then we would only be able to use the base salary. And if you're part-time, we also would need 2 years worth of notice of assessments to show the consistency of the hours. So keep that in mind as well. If you don't have them, I do have a phone number that any of my clients can access their notice of assessments, and it probably takes about 2 weeks to get them. So if once you start the process, if you can just give me a call and I can get you that phone number so you can get them. So proof of down payment is also something that's very important. It's very important when you come in to apply for a mortgage, you tell me exactly where your down payment source is coming from. So I need to know if it's from your own resources, which is considered your own savings. We will require a 3-month banking history on the money. Or I also need to know if the down payment is from a gift. So if it's a gifted down payment, your CMHC fees, which I'll kind of touch on later, are going to be higher than if it's not a gift. So just keep that in mind. If you have 3 months history and you can show that it's been sitting in your bank account and accumulating, then they would consider that your own resources. With a gift, you require a gift letter, and it would have to be from an immediate family member. Any of your bank statements that you do provide to me would need to also show ownership. So a lot of times with the big banks, I know that at least there's TD and Scotia, they don't physically show your name on the statements online, so there's a different area that you're going to have to go in your bank to show that, and I can, again, help you navigate that as well. First-time home buyers are actually my favorite type of buyers to deal with because they are all very excited, and they tend to have everything up front for me. So, and if they don't, I can definitely help with the process and get them where they need to be. So closing costs, you are going to need to have 1.5% of the purchase price available for your closing costs. So it doesn't mean that you're going to need that. It just means they're going to want to see that it's available. So they will ask to see that. Possible closing costs could be legal fees, a home inspection, an appraisal. Private sales normally do require an appraisal. It's pretty much standard across the board just to make sure that you're paying fair market value for the home. Land transfer taxes, in this case, if you're a first-time home buyer, you will not have to pay land transfer taxes. However, if you have a co-applicant on your application that is not a first-time home buyer, you will have to pay half of the land transfer taxes. So, and then there's, of course, HST on your CMHC fees. So another thing to keep in mind is that when you put an offer in on a home, you're going to be putting a deposit with that offer. So what happens is once your offer is accepted, it will be credited towards your down payment when you close the transaction. So what is CMHC insurance? CMHC is a government-backed insurance that basically allows people to purchase houses without having a 20% down payment. It protects the lender in case of mortgage default by the borrower. So it's paid for by the borrower, but it protects the lender, basically. Usually it's included in the mortgage, and it runs several $1,000s depending on the purchase price and the term of the mortgage. CMHC fees just went up, so if you only have 5% to put down, you're looking at 3.85 now for a non-traditional down payment. So if it's gifted, 3.85, and I'm going to say 3.5 for a not gifted, but don't quote me on that because it, again, just changed yesterday. So if you have less than 20% down, you must be approved by both the insurer as well as the lender. So if you get a pre-approval of $200,000 and you pick a house that maybe has some issues with it, say for example it has UFI or something that needs to be removed, the lender may say, yeah, it's a great house, but the insurer may say, no, we don't insure houses like that with that, or say it was a past grow up or something like that. You're opening a whole can of worms, and things need to be remediated before the insurer will approve that house. So the good news, if you're a first-time home buyer, is that again, you don't have to pay the land transfer taxes, so you can save up to $1,200 per person. You're considered a first-time home buyer if you have not owned a home in 5 years. So if you owned 20 years ago and you sold that house and then you rented for 5 years, you are now a first-time home buyer again, which is a great thing, I think. You can borrow from your RRSPs tax-free under the Homebuyers plan. So how that works is you can borrow up to $25,000 from your RRSPs to use towards your home purchase, and you have 15 years to pay it back. So starting 2 years from when after you purchase the house, you would have to start designating a certain amount to your new home buyers plan, and the government will send you a notice about that. So for example, if it was like $10,000 that you're borrowing, then you have to designate $600 every year towards of whatever you're contributing to your RSPs towards that. If you did not contribute, then what happens is you'd be taxed on that $600 for that year. So I would say it's a pretty good plan. I mean, a lot of people, if they have money in a tax-free savings account, I always recommend that they take it out of the tax-free savings account if they're not purchasing for 90 days, and then take it out of their RRSPs, and then they can get the tax break. So again, the money has to be in the RRSPs for 90 days before you can withdraw it. So that's one way that you could take advantage of that if you have a bunch of money sitting around and you'd like to make some extra interest and get the tax break as well. So another thing that you will get as a first-time home buyer is a credit of $5,000 on your income taxes. So it translates to an extra $750 in your pocket at tax time. Also, just so you know, one of the services that I offer in my office is income tax, and I do offer free tax returns to all of my people whose mortgages that I have placed the year before, so I can make sure that you get that first-time home buyer tax credit if you qualify for it. Okay, so this is just a few things I wanted to touch on while you're shopping for your house. After you get your pre-approval and you start doing your shopping, sometimes there's a long period of time between when you are shopping till the time you actually find what you're looking for. So, or you may do an offer on a few houses and they may fall through. You want to keep this in mind, that you are getting your pre-approval based on the information that you've provided. So do not make any major purchases because it's going to affect your credit. If you're qualified for a couple $100,000, you're going to want to make sure that you don't go out and make like a vehicle purchase, because it's going to change what you are qualifying for with your debt ratio. You don't want to change employment. So if you are approved based on working at one job, you don't want to quit and start a new one unless there's no probation and it's in the same industry or something like that. Just because your situation's changed now, if you're not past your probation, the lender will want to know that you are, and that's a huge risk that you're taking. So just keep that in mind. If there's any opportunities that come up, you will need to be past your probation. Any information that on your application that cannot be supported by paperwork may not be able to be used. So if you say that you work for a certain company and I get your information and it says that you're, that you're considered a contract employee and that you're considered self-employed, something like that, then the paperwork's going to change as to what we need. So the best thing to do is to bring in all your paperwork up front so we know what we're dealing with and how it needs to be submitted. For your down payment proof, if you're providing 3 months worth of bank statements to me, it needs to be pretty it has to be explainable. Okay, so all large lump sum deposits must be explained, or they're going to want to see the exact proof of their origin. This is the Money Laundering Act. That's the reason why they asked for this. It's actually a government requirement that we explain where this money has come from. If you have a gift letter and it shows that your parents gifted you $10,000 and you've got a deposit of $15,000 in there, that's not going to fly. Things need to match up and to make sense. So again, that's something I can walk you through. And if there is something, if say you sold a car or something, we can get the receipt for you selling the car. Just make sure you explain things. That's all. So the application, again, is the combination of the borrower and the properties. I never recommend that anybody goes in cash, just because I've seen things fall apart at the last minute where, the property wasn't acceptable, the borrower couldn't get the paperwork, and we've had to go to different lenders. It's a huge stress on both yourself, myself, and the real estate people involved. And, if it's something that we can do in 5 days or even 3 days for the financing, just for peace of mind, that's probably a wise decision. Unless, of course, the property has been sent to the lender and the insurer prior to the offer. I will send properties up to lenders and insurers before you physically put an offer in, just so that you can go in for cash, but then you're going to have to wait a couple of days for them to come back from the insurer. That's the only issue. So let's touch on purchase plus improvements, because a lot of my clients that are first-time home buyers don't have a huge window that they can shop. They're just starting their jobs. They don't have they have some student loan debt or whatever that they have. Their budget's probably like, you know, under 200,000, 250,000. So sometimes they find houses that they look great, but they've got one room that, it's maybe a 70s kitchen and they want to do some renovations to it. So purchase plus improvements is something that basically almost all of my lenders offer. It allows borrowers to get extra money to do renos on the home at the time of purchase. So you can borrow the lesser of 20% of the future value, or $40,000, to do your renos. So what happens is you would have to do something that is going to add value to your house. Some lenders require that we do an appraisal up front for this, and then once the renovations are complete, then they'll do an inspection, just a re-inspection that is maybe $75 to just state that everything's complete so they can release the funds. So you don't physically get the money until the renovations are complete. So you're going to need to have some money to fund those renos while they're being done, and then the money is held in trust with the lawyers. Once the lender gives the lawyers the okay to release that money, then they will pay your contractors directly. You can do your renos yourself as well, but they will only pay you for your material. They will not pay you for your labor. Any red seal trades need to be signed off on. I believe I have this in the next slide. Oh, I do. Yeah. Okay, so basically just going over everything that I just said. Okay. So I always recommend that if you're planning on doing any major renovations in the next 10 years, that you consider doing it when you purchase your house. And the reason for this is because you cannot physically refinance your house until you've got 20% worth of equity built up. So odds are in the first 5 to 10 years, you're not going to build that much if you're only putting 5% down to begin with. So you probably want to consider doing this first. With your purchase, because we can't do it as a refi plus improvements until you've got some more equity built up. Okay, so that's me. I thank you for listening in on the webinar, and I would like to open it up to questions. I'm just going to stop the recording.